Morning, Assalamu alaikum. I think I'm here because, as from the Western point of view, from the UK Islamic finance point of view, I was there at the beginning, if you like, when the British bank started to interact with the Islamic finance market as it had grown, in our experience in those days, mostly from the GCC in the direct interaction with London, but also to an extent with Malaysia, even in the early days. So I'm talking about 1979, 1980, 81, 82. And it was during this period that the some of the critical issues of form over substance developed. And I'll explain a little bit about why they developed in the way they did and how that trail has led to where we sit today. The first approaches that we received, and I was fortunate enough to be working in a Saudi bank at that stage, the first approaches we received alongside Citibank and Chase in those days as the three principal handlers of cash flow from particularly the GCC. The requests started to come in from the Islamic banks who had been very successful, the national Islamic banks who had set themselves up in Dubai and Qatar and elsewhere, had become very successful in raising cash. And in those days, of course, pre the development of the economies based on around the oil at that stage, very early, there was too much money and not enough ability to absorb it in the local economy. So they looked elsewhere for counterparts. They looked to London to provide a treasury. They looked to London to provide liquidity management solutions because it was very difficult to apply them in the local market through financing local business because there was so much money and, comparatively speaking, relatively little business. So they came to London looking for solutions, and they came to banks like ours and Chemicals and Chase and the like. And we started to seek solutions, and we found in that early phase a similarity between the Murabaha contracts and the proper merchant trade finance business, which London was busy with at the time. And that I think the first cross-border transaction was either done by ourselves or Chase. And Chase, it was Shell Chemical business. And in those days, the form of the business and the substance was a purchase and a sale between the buyer and the seller. We would have the documentation invoice, we would have it invoiced, we would have the bills, we would have the markup, and the whole thing worked properly. And that was before VAT, particularly, and before the role of taxation in finance became so powerfully strong. By the time, in fact, the financial environment changed, VAT was introduced, we were, certainly in London, the dominant player in managing the spare cash, the spare liquidity of the Islamic banks. Very important part of the international Islamic banks. The Islamic banks didn't have and still don't have a money market. There is no Islamic money market per se. There are bilateral transactions, but there's no interbank platform. Everything is bilateral, and so all the bilateral business was being done with banks in London. So the banks in London were controlling the cash flow of the Islamic treasuries at that stage. So when the environment in the West changed, it severely disadvantaged the Islamic banks. We moved from a position where it was okay to buy and sell goods at a markup to one where that was severely disadvantaged by taxation, where VAT and sales taxes were suddenly introduced on business, and it became almost impossible to continue. Sheikh Salah Kamel, with great foresight at the time when he had our Baraka Bank here, looked at that stage to re-intermediate the business with the accepted bills market, which was a big, still at that stage, a major part of the London scene was the bills discounted at the Bank of England, with which after 300 years, interestingly, you can't get that done any longer in the conventional market than over the Islamic. But that was turned down by the scholars at the time as being a form over substance issue. That the fact that it was financing proper trade wasn't enough to eradicate the fact that there was an interest element in the calculation of the bills and the whole discount issue. Anyway, what we ended up with was the shift from this is where the shift from the true Murabaha business came into the commodities Murabaha business that we see today. The commodities business was active as a part of the commercial Murabaha business in London, because the only market in the world which offered a truly compliant platform for the business was the London Metal Exchange. And I'll explain why that was the case at that time. We were looking for a terminal market where you had delivery. We were looking for a market which didn't suffer the VAT, and the LME was black boxed for VAT, and it was highly liquid. And in those early transactions with the London Metal Exchange business, that was buying the metal, it was taking security over the metal, it was selling it on. There was a contango environment, so that it was actually advantageous to do that kind of physical transaction, which was in effect storing goods and warehousing them financially for producers, so that they could intermediate the period between production and consumption by the end buyers. In those days, banks were not allowed to be members of the London Metal Exchange. It was impossible. It was mostly done through private members or corporations who either dug it out of the ground or turned it into cars. It wasn't until post-Sumitomo really that that world changed. So this London Metal Exchange at that time provided a very nice and acceptable platform. COMEX, we couldn't use that because that was a futures market. We looked at all of the other markets, the oil markets, we had our issues with the grain markets and elsewhere. The only one that really worked practically as a true compliant product market was the LME. But then that changed as well, and this is where the commodities Murabaha element entered into it. We ended up with a lot of business written through those markets. All of a sudden, the world, as it will, changed its economic environment. The regular contangos that we would find in those markets turned into backwardations, and it became impossible to naturally provide finance at better than interest rates for the banks. The volume of business had grown enormously in the Islamic banks, and it wasn't possible to accommodate the volume that the market that the Islamic market wanted to deploy in short-term transactions, because they were looking to simulate bank deposits or interbank market, and so they were looking for straightforward short-term placements, and only in these markets could you get it. It's very difficult to do that with the true Murabaha. And so corners started to be cut. So we ended up with a situation where the commodities Murabaha became a convenient piece of the commodities Murabaha as we know it today, which is clearly a form over substance solution to the interbank problem that the Islamic banks had. So that's how we got to that position. And one of the things that we did, thinking back to the early 1980s, was we went to law, because it was the Islamic banks did not want to be taxed on their business beyond what the conventional banks were. So if we run a treasury, we don't want to be doing business which is so heavily disadvantaged cross-border. And we got a QC's opinion going back into the 1980s to say that this was financing, not trading. These commodity murabaha transactions are finance, not trade, and therefore they became acceptable from the point of view of financing substitutes, and that's what retained London's position as a centre for liquidity management. Now that it's interesting in itself because it illustrates two things. It illustrates the change that went through the business, the evolution of the pure murabaha transactions, which still exist, and there's still plenty of pure murabaha being done. The evolution of that into what we call commodities murabaha. We have to understand the difference, but there's no doubt that the commodities murabaha business is still today a purely form over substance to enable the interbank market to continue. And without it, the scholars and the practitioners know that there is no other solution in the market today. We did think that the Sukuk market would be the solution. The Sukuk market was envisaged when we first saw it as a solution to the Islamic capital market, the Islamic interbank market, a tradable instrument between banks which would be asset-backed. And it was quickly picked up by the big conventional banks who saw it not as an asset-backed liquidity tool for the Islamic banks, liquidity management house, the liquidity centre set up in Bahrain, were all set up in anticipation of the Sukuk revolutionising the interbank market between banks and replacing murabaha. Here we would have something which we could truly trade. But it got picked up by the big conventional banks who saw it only in the context of debt capital markets, and that led to that market becoming rather like the commodity murabaha. We ended up with the Justice Taki's famous and, to my mind, very justified statement about the nature of the Sukuk market. And all of these matters lead back actually to the problem not just in the in the Islamic market, but also in the conventional market. I think we're beginning to understand that the conventional market runs entirely on form over substance. As I mentioned earlier, for 300 years the Bank of England fought against the kind of government borrowing, the facilitation of government borrowing through the central banks that we've seen in the time that I've been working in the City of London. They have been invented and then ruined Europe. It's only taken a few years. It's only taken my career, the length of my career, for form over substance to completely change the conventional system. We don't, we've lost track of self-liquidation. The concept in Islamic finance, as I understood it at the time when I first joined in, was that it was about transactions which were self-liquidating. You bought and sold things which would then be self-liquidating. So that's what eradicated a very great deal of the riba aspects of trade transactions, was their settlement through natural, the natural flow of business, not the creation of money out of additional interest payments or penalties or what have you, which would come along later. So self-liquidating, the concept of the usufruct, all has completely disappeared from the conventional system. We have no self-liquidating concepts within government bonds, and the whole of the accepting bank accepted bills disappeared in seemed like moments when the big bang came along. So the conventional system is suffering far more from the effects of form over substance than the Islamic system. But that really, I just wanted to draw people's attention to how early in our development of Islamic finance this form over substance debate started. we are reinventing. When I began, our platform for Islamic finance was much wider in the 1980s than it is today. And a lot of it's due to this, it's dealing with tax, regulatory and accounting matters which apply to conventional finance and living our lives as Islamic or Sharia compliant financial organisations within this tax, accounting and regulatory framework. And in the 30 plus years that I've been witnessing this, we have witnessed these rules, regulations and laws shift heavily to preferring debt over equity. It's an old saw of mine. It is a bit simplistic, but it's easier to be simplistic with the relatively small amount of time. But it is very difficult. When you look at what we tried to do to retain the Islamic interbank market, what we were trying to do was prove, and this is what you'll see it in almost every Islamic transaction in most regulated and developed economies. I include not just the Western economies in this. We're trying to put a level playing field in for the taxation and for the capital adequacy of our organisations. And in almost every environment, debt is preferred. We find ourselves trying to categorise what are essentially trading or equity-based transactions as financing. That's what we tried to do with the Murabaha. We tried to categorise it as interest from the conventional point of view, so we wouldn't pay tax any more than anybody else. All we were trying to achieve was a level playing field for tax. People who have debts, who have financing transactions, if it's a piece of real estate, and you can categorise some of the money going into that as lending, as interest, you will end up with less tax in your outcomes than if it is all equity. If it's the same with trading transactions. And that drive to apply capital and to reduce your tax burden by promoting the debt side of the business is one of the biggest contributors to this form over substance debate. It's a very large part of that, the aspect of the debate. And if we want to solve the issue of form over substance, which we all dearly would like to do in Islamic finance, then and if we really need to find a level playing field, then we have to look further than just the nature of the contracts. We have to look at the implications of all of these aspects in terms of how we apply the capital, how we pay our tax on these transactions. And in Western environments particularly, but not just in the West, very hard to do it. We need to do that, but also the conventional markets need to understand that this has been very bad. The creation of the conventional system has led us to the kind of crisis which is no longer solvable. There is now in the few years, in the 30 or 40 years that we've been building up this debt mountain that the government can't repay, or the debt mountain that our children will be repaying for their school fees, or whatever it is that we need to pay for whatever we're paying for with all this money that we're printing, which doesn't come from any kind of productive enterprise that I can see. Gaith Shabsi telling us 15 years ago from his economic viewpoint, asking the question of a group of Islamic bankers that I recollect, saying, I sit here and I just have a very simple question for all you very clever bankers. I'm just a humble economist, but I have this question for all you clever bankers, because I don't understand it. He said, I have, on the one hand, all of these bonds, but on the other hand, I find that I have productivity of about $1 for every $1 million worth of bonds if I equalise the maths on this. So it seems to be about $1 for every $1 million. So that seems to be an awful lot of money with awfully little productivity to support it. How does that work? And very simplistically, it doesn't work, and we're seeing an enormous amount of leverage in the market, which we can't get rid of, which isn't solvable without extreme. They can't solve it in the European Union, they can't solve it in the IMF, and Islamic finance has been prey to the competitive environment which has enabled that kind of economic franchise to develop. And it isn't the same economic franchise, it isn't the same economics, it isn't the same business as when I joined the City of London. It has changed in this is a period of anomaly. Islamic banking sat much closer, sat much more easily within the conventional banking world of 40 years ago, in the merchant banking environment. It could have a platform. It sits much less easily in there now, because over that period of time, against everybody's best interests, we have seen the enablement of financial structures through tax and accounting practices and elsewhere, which have led to disaster. And the Islamic banks have had very little choice but to move alongside them or to stop operating. So, okay, well, I can't compete with that, so I won't. So form over substance, we will, until we can present our case effectively to illustrate more articulately than I can the specific examples of why, in a properly executed form, the Islamic economic model, which, let's face it, is Abrahamic in its roots in the same way as the other systems. No reason why everybody shouldn't adopt this. Why it shouldn't be a universal system. Why if we can illustrate why an Islamic economic model based on substance and substantive practices, which were not dissimilar in some ways from the merchant banking practices of the 50s, 60s, 70s, why that wouldn't be a better alternative. And we can resolve the form over substance problem to the benefit of everybody, including the conventional system, by providing the examples and the solutions articulately enough. As I say, I can't do it, but articulately enough. Thank God for Lord Sheikh and similar members of the House of Commons and the House of Lords who take this seriously and listen. We do have a government now with economic members of their economic committees who are asking these questions from all religions, saying, our conventional system really isn't working. What have you got in yours? And we have an opportunity to resolve this form over substance issue. But we also have a great deal of threat in there, is that if we continue to accommodate too much of this commodities murabaha, if we continue to accommodate too many of the form items that enable Islamic finance to keep going, when the conventional system looks at us to have an alternative, when they say, oh, well, actually, really, maybe we should look at what Islamic finance is doing, and they just see, as they did in the last crisis, what problems that we were having with the Sukuk market in Dubai and the issues, and that's all they see. They won't see a solution, and we won't provide that alternative, which is sitting there available for everybody. And we have to be careful not to enable this substance, this form issue, to defeat our opportunity that is so divisive that that defeats our opportunity to represent at a critical time, Islamic finance, the Islamic economic model as a potential solution in many areas to what's happening in the conventional system. Anyway, that's the basis. I thought it would be interesting to share that experience of 30 years ago.
Thanks very much, Richard.